Hello friends, welcome to the May edition of Monthly Viewpoints. Last year, we had seen heightened global volatility on account of the strong US dollar, rising crude prices, and the US-China trade tensions. Consequently, equity markets had seen a sharp fall at the end of the year. However, globally, equity markets have pared most of their losses and have seen a sharp V-shaped recovery year to date in 2019. Locally, Indian equities have endured some volatility in the past couple of months. As we approach the outcome of the general elections by the end of the month, we expect this uncertainty to continue. Let's start with the global macro. The key drivers for the global market so far have been the strong US and Chinese economic data and rising optimism regarding the resolution of the US-China trade disputes. In addition, the US Fed and other central banks have become dovish, thereby opening up space for policy easing in the emerging markets. Consequently, emerging markets have seen strong FPI inflows as the EM fund managers continue to correct the light positioning. India alone has seen FPI inflows of almost $10 billion in 2019 year to date. Brent crude prices saw a sharp rally above $75 per barrel as the US announced that it would not extend the waiver of the sanctions on Iran. However, additional supply expected from the OPEC Plus coalition has led to a cooling down in crude oil prices. Rising oil prices remain one of the key risks to be monitored for oil importing emerging economies such as India. Amidst all this news flow, it is notable that the Indian currency has remained stable even as the dollar index has continued to strengthen. Coming to the domestic markets, last year we had seen some liquidity tightening due to the INFS crisis at the end of the year. This then led to some concerns regarding a short-term cyclical slowdown. However, we are seeing some dichotomy in the key macro parameters. While the IIP numbers have been a bit weak, the PMI figures are robust and the export data has improved. While the auto sales numbers are subdued, we have seen that construction-related indicators such as cement and steel production continue to remain strong. The recent slowdown in some consumption segments like auto is likely due to the uncertainty related to the general elections and the NBFC-induced stress. However, election uncertainty will be over by the end of this month, and the liquidity is expected to improve starting in the second quarter of this fiscal as the currency in circulation falls post the elections and a balance of payments is also expected to improve. With normal monsoons being forecasted by the IMD and near normal monsoons being forecasted by SkyMet, the progress of the monsoon season will be a key variable to be monitored for the consumer sector. With the headline CPI inflation expected to come below the RBI's target of 4% in the next few months, we expect to see further policy loosening from the RBI. This should be a positive both for business and investor sentiment. Another positive data point is that the GST collection in the month of April reached an all-time record high of 1.14 trillion rupees compared to the average monthly run rate of 980 billion rupees in the last fiscal. Coming to a view on the markets. Last year we had seen that amidst the heightened volatility, the Nifty returns had been lopsided, the top 7 or 8 stocks contributing more than 3/4 of the Nifty 50 returns. With the market factoring in higher chances of the current government coming back, we have seen some confidence coming to the markets this year. Over the past couple of months, we saw a rally in the markets, especially in the mid and small cap stocks. However, the markets seem to have taken a breather in April. The large cap Nifty index was flat, while the mid cap and small cap indices were down 4 to 5%. The flat Nifty does hide the significant volatility as we saw that the India NSE VIX index spiked almost 27% in April and reached close to its 5-year high. We expect this volatility to subside post the elections and the markets to pick up from here. The broader earnings growth for the market remains muted, and the 1-year forward price to earnings multiple for the Nifty 50 index stands at 19 times, which is at a premium to its long-term average. However, valuations for the broader markets have corrected, and we believe that they offer a good return for long-term investors. We remain constructive on India's overall economic growth and hence recommend that investors continue to build their equity exposure for the long term. The current volatile environment is actually very conducive for bottom-up stock picking. A multi-cap fund stands out in this environment as it has complete flexibility to move across market cap and across sectors. Typically, a multi-cap fund also has significant allocation to mid and small cap stocks, which we believe continue to have attractive valuations at this point. Select themes which we are participating in include consumption, which includes the consumer and consumer discretionary sectors, financials, which includes private banks, corporate banks, and select NBFCs, and industrials, which includes capital goods. We offer a basket of suitable funds for equity investors to choose from. Thank you and happy investing.